I worked at Point72, one of the largest hedge funds in the world, and I can tell you there's a lot of bullshit layered on the internet about how the best investors make money betting on stocks. It's not rocket science, but it takes a real skill that you can only develop over a very long period of time. In this video, I'm going to break down how stock investing actually works, the same process that the best hedge fund analysts use every day. Before we get into this process, you should know that there isn't only one way to do fundamental investing. People make it seem like everyone's doing the same thing. That's just not true. You've got multi-manager hedge funds like Citadel and Millennium. There, it's not about buying great businesses and holding them for 2, 3, 5, or 10 years. Nvidia, Netflix, Amazon, Microsoft, Apple are all great businesses. No one can argue against that. In the multi-manager world, it's about an incremental change in the business. In particular, a stock might be a short not because it's a bad business, but because near-term earnings are likely to disappoint. For example, Amazon in early 2022 was dealing with temporary supply chain issues and tougher compares after the initial pandemic boost. It was a short not because it was a bad business, but because near-term earnings were likely to disappoint and the company was likely to guide down. So it was a short because of the incremental change in the negative direction, not because of business quality. Other investing approaches take longer-term view on stocks. Their portfolios might consist of 10 to 12 positions that they hold for 3 to 5 years, or in Buffett's case, for decades. Bill Ackman's Pershing Square takes a similar value approach and sometimes even an activist approach to investing, where his portfolio consists of 10 to 12 concentrated positions. For example, Uber makes up about 20% of their public equities portfolio. This is their investment thesis on Uber from Pershing Square 2025 annual presentation. They lay out their investment thesis of why Uber is a high quality business and its stock is likely to double over the next 3 to 4 years. Things like attractive business model, strong revenue and earnings growth potential with a robust free cash flow, and just an overall attractive PE multiple given its 30% plus growth potential. They also believe that the risk from AV or autonomous vehicles is limited, at least in the medium term of 3 to 4 years, because they believe that a large-scale self-driving adoption is unlikely to happen for many years to come. And this is an important argument because Google has Waymo and Waymo has a partnership with Uber, but we also have Tesla that's developing a different type of self-driving software than Waymo, which is very hardware-based. I have included a full link to the Pershing Square's annual presentation in the description of the video in case you want to check it out yourself. The point here is that there is a massive spectrum of investing styles and approaches to fundamental investing. But at the core of it, regardless of the exact investing style, investing is really about having a view on a stock that is different from what most other people think, or is different from the so-called buy-side consensus. The idea is that what most other investors think about a given stock is already priced into the stock, and that's why it's called consensus. Your job is to create alpha. Yes, you can buy some Visa or MasterCard stock today, and that stock goes up tomorrow. But that doesn't mean that you had a view that is different from consensus, and that certainly doesn't mean that you generated alpha just because you made money. The stock might just be up because the market is up, or the so-called beta. A great example of having a view that is different from consensus is from 2022, when most investors hated Meta. The consensus was that the CEO Mark Zuckerberg was wasting billions on the metaverse and the user growth was slowing down. Most investors were short, but a small fraction of top hedge fund analysts took the other side of the trade. Their view was that Meta was still printing cash, data was showing the Reels was gaining real traction, and they believed that when the market forces Meta to cut costs, they will cut costs. And that's exactly what happened. But at that time, that was a non-consensus view. Meta ended up beating earnings and announcing a massive cost-cutting plan. The stock was up more than 20% in a single day, and it's been up 6x since then. That's alpha. That's being different and being right. And by the way, Meta is now entering a similar territory after acquiring Scale AI, spending a lot of money on building an AI team, and investors are starting to question whether that spend will be justified in the future. Whether it will play out the exact same way with their metaverse spending, that remains to be seen. The research process investors follow is extremely elaborate and in-depth. It starts with a deep understanding of the company and how the business actually works. This is probably the most underappreciated aspect of the investment research process. They're hedge fund portfolio managers who have been covering the same stocks for decades, and they are so deeply ingrained in the inner workings of these companies that very few people can understand. Then comes an extremely detailed financial model that allows you to test your assumptions around the key drivers of the business. You update it constantly, calculate your target prices, run sensitivity analysis, and think in probabilities. You also need to understand the stock itself, how management guides, what they say on earnings calls, what moves the stock, what the key debates and the overall narrative are. And then there's everything else around the stock: sentiment, flows, positioning. All of these things are critical in determining how the stock reacts on any given news on incremental change. Finally, managing risk is essential. First, at the individual stock level, you want to evaluate the risk and reward of that specific trade. And then secondly, at the portfolio level, how do you construct a portfolio of 20, 30, 40 positions and size them in a way that makes sense given the risk exposure you're willing to take on? It takes years, even decades, for investors to master each step of the investment process and develop their own competitive advantage and unique style of investing. Because at the end of the day, to have longevity and success in this job, you need to be doing things at least a little bit differently. Otherwise, you're just consensus. When you're starting out as a junior analyst, in the first few years, more than 90% of your time is spent on building detailed financial models and analyzing businesses. Being good at picking stocks is a completely different skill set that comes much later in the development journey. The reason the biggest hedge funds have an edge, besides all the uniquely developed and robust investment processes of all the investors working there, is that they spend tens, if not hundreds of millions of dollars every year on best-in-class tools, resources, and access to information. This is only possible at their scale. Funds with massive assets under management, or AUM. It creates real advantages. Unlimited and preferential access to the sell side. They constantly speak to the best equity research analysts from JP Morgan, Goldman Sachs, Morgan Stanley, and so on. Direct access to management. They can get meetings with investor relations, the CFO, even the CEO of companies multiple times per quarter, which is huge, having that close relationship to management of the companies you're investing in. Proprietary data to track macro and company-specific metrics in real time. And finally, they have the right technology and infrastructure to do all of the steps of the investment research process we just discussed quickly and accurately. Do research, update models, track data, and manage risk at scale. Having all these resources on top of years of experience and a well-developed investment process based on the steps we discussed is what makes consistent success possible in today's age of increasingly efficient and competitive equity markets.